You're watching Trading Forex Stories, where we move beyond the basics and deconstruct the strategies of the serious trader. How many times have you nailed the direction, watched the trade go into profit, only to see it reverse and stop you out before it rockets again? Or worse, you catch a massive trend, but your profit feels disappointingly small. The market gave you the signal, but your results didn't match. The problem, more often than not, isn't your analysis, it's your position size. Welcome back, veterans. Today, we're cutting through the noise and diving into the engine room of professional trading, position sizing models. This isn't about risking 1% per trade. That's kindergarten. We're talking about the sophisticated frameworks that determine not just if you survive, but how you capitalize and scale when you're right. Forget gambling with fixed lots. Expert trading is a probability game managed through mathematical edges. Your position size is the primary lever controlling your risk-adjusted return. It's what separates a disciplined portfolio from a chaotic gamble. We're going to break down 3 key models beyond the basic fixed fractional. First, the fixed ratio model, pioneered by Ryan Jones. This is for scaling aggressively during winning streaks. It doesn't focus on your account balance, but on your accumulated profits. You add contracts based on a predefined delta per profit unit, allowing for exponential growth during hot streaks while providing a natural slowdown during drawdowns. It's aggressive and designed for trend followers who know how to let winners run. Next, the Kelly criterion. The mathematician's approach. This model aims to maximize the long-term growth rate of your capital by calculating the optimal fraction to bet based on your win rate and win-loss ratio. It's theoretically optimal but brutally unforgiving if you overestimate your edge. We'll discuss the fractional Kelly approach. Most prudent traders use taking half or a quarter of the suggested size to harness its power without embracing its extreme volatility. Finally, let's discuss volatility-adjusted position sizing. This is where you align your risk not just to your account, but to the market's character. Here, your position size is determined by the asset's volatility, typically using average true range ATR, a 1% risk on a COM/Eurost pair is a very different position than 1% risk on a volatile GBP/JPY. This model normalizes your risk across different instruments and market conditions, ensuring a stop-loss is placed at a technically logical level, not an arbitrary dollar amount. It respects the market's noise. Integrating these models requires brutal honesty about your own statistics, your win rate, your expectancy, and your psychological tolerance. There is no best model, only the model that best fits your strategy's profile and your mental capital. The goal is systematic replication, not heroic one-off wins. So, which model resonates with your trading DNA? The aggressive scaling of fixed ratio, the mathematical precision of fractional Kelly, or the market-responsive logic of volatility-adjusted sizing? Let us know in the comments below. Debate the pros and cons. What's your primary model, and what have you learned from it? If this deep dive into the mechanics of risk management added value to your process, smash that like button. It helps the algorithm share this with other dedicated traders. And subscribe to Trading Forex Stories for more advanced content that assumes you already know the candles. Until next time, trade not just with direction, but with dimension.